half, and the S&P's gone up. So don't make that false linkage that, well, if we go into recession, commodities get hurt. No, they're an undervalued asset category. And when people get discouraged with stocks, and I think they're going to be by late this year and early next year, they're going to feel the pain again. At that point, they'd have to move somewhere else. And I think the stellar place for them to be will be gold and silver. But in the broad asset categories, I think commodities in general and commodity-related stocks will be a place to be and perceived to be a safe.
The week concluded with gold reaching a record high, closing just below $2,100 on Friday after a 4% weekly increase. Although briefly surpassing this level on Sunday evening, both spot and futures prices experienced a 2% decline on Monday. The week commenced with another record for gold prices, touching $2,100 per ounce in spot prices. The Sunday evening session for spot gold began with significant momentum, breaking crucial resistance levels and establishing a new all-time high of $140.99 within the first half hour of trading. Michael Oliver expressed surprise at the unprecedented market activity, particularly on a Friday, which he perceived as notably robust for metals and overall market performance. The unexpected surge in prices, with gold rising over $50 and silver by 50 to 60 cents on Sunday night, caught him off guard, although he had anticipated such events eventually. Market positioning uncovered in the Commitment of Traders report, where commercial banks favored short positions while managed money drove prices up, raised concerns for Michael Oliver. He emphasized that the appreciation of gold and silver signifies more than just wealth accumulation. It reflects the dollar's weakening against global currency. However, the major concern lies in manipulating gold and silver prices, where silver is sold to drive down gold prices. Michael Oliver criticized market manipulations, particularly in the silver market, where significant quantities are abruptly sold, distorting market realities. He anticipates global challenges to such control mechanisms, citing instances like India's reduced silver imports due to major supplier shifts from the UK, China, Hong Kong, and Singapore to the UAE post-CEPA. The agreement lowered silver import duty within the CA to 9% in 2023. Such shifts could potentially lead to shortages and alter the dynamics of gold and silver pricing. Moreover, Michael Oliver predicts a potential global shift away from the dollar as a reserve currency, envisioning a scenario where the pricing of commodities, including gold and silver, might move to different exchanges worldwide. Now we'll present you clips from Michael Oliver's interview. If you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you and enjoy the video.
Bonds, and we're talking price now. So if price goes down, yield goes up. Okay, remember that. T-bonds we got bearish in 2020, late 2020, well before we got bearish on the stock market in early 2022. But bonds started a major bear market then, the yields rising. Okay. They made a low last October, a year ago, at a level that we predicted would be a bounce point, but only a bounce point. And sure enough, they had a nice bounce. They ran up nicely and they stabilized. Well, you'll notice last October, stock market also made a low, and so did gold. Gold was in the low 1600s. It was a bear trap low, we defined it as. Meaning, if you sold that downside breakage, you're caught in a bear trap. Okay. And sure enough, it exploded back to 2000 again. But during that same time, T-bonds rallied from the October low. S&P rallied. And T-bonds then leveled off and basically peaked around March or April of this year. It started to roll over again. What did gold do? Same thing. In other words, T-bonds were technically in linkage with gold, which was very interesting because it doesn't always happen, but sometimes it does. And we defined that months ago, that watch the T-bonds and gold because they seem to have their legs strapped together, almost week by week. And we made a difference, though, because we saw gold pulling back and it dropped into the 1800s, this October, whereas T-bonds crashed. They didn't just go down. They took out last October's low, which would be like gold being below 1,600 if it had matched it, and well below there. And they did it in crash mode. There was the T-bond chart. If you looked at it, it looked like some collapsing commodity market. Didn't look like what the U.S. government debt market should be looking like. I know it had to vastly upset Yellen and the central bank and the Feds, because that's the asset they can't have crash. They don't care about NVIDIA or something like that. If that happens to go down, they couldn't care less. But their T-bond market, that's life or death for them. And so we argue that expect a V-bottom in the T-bond market. And in fact, we've gotten one over the last month. Lag to gold. Gold turned up about a month before T-bonds did, but then T-bonds got back in sync with gold and had a sharp rally. Now, gold was back to its all-time highs, but T-bonds were having what we call a V-bottom. And I think in part that was due to overnight buying by the Treasury and the Fed, in the dark type buying. And there's also some very large asset managers out there who realized that while bonds were a horrible place to be last year, they were even worse than the stock market. So the 60-40 portfolio was lethal. That the bonds were oversold now and likely to be worth buying. And I think they plowed into the bond market. That's why you're getting this V-bottom. But I suspect what it means is, and I think the broad market interprets it partly as one of the factors, the Fed can't raise rates anymore. No matter what they want to say, they cannot do it. They cannot destroy their bond market. At all costs, they have to print, whatever it takes to support that market. So I think the stock market right now is pricing that in. I think gold has all along priced that in, meaning it's always known that when the paper asset bubble breaks, stock market, the central bank will have to revert back to that which they do best, which is monetize debt, print money, cut rates at some point. That's why it keeps coming back to its highs. Find me a commodity, or find me any asset almost on the planet that has kept coming back to its highs. Gold is the one, okay? It has a reason for that. And we don't think it's going to stop at 2,000 this time, by the way. But I think that what happened to the T-bond market is critical in terms of the change in the Fed policy. Now the debate among analysts and stock analysts and talking heads on financial TV, it's not about whether they're going to stop raising rates. It's when are they going to cut? That's the debate now. And they're correct in that. I suspect it's going to be sometime in Q1, not Q2 of next year. But we'll see. But gold knows that. And gold is a monetary metal. It will reflect the degradation of the money unit.
In a riveting conversation with Michael Oliver, founder of Momentum Structural Analysis, we delved into the nuanced landscape of commodities, gold and silver for the upcoming year. Oliver's retrospective on 2023 unveiled a skeptical eye on the limited rally in the U.S. stock market, with a potential shift in asset allocation towards historically cheap commodities, particularly grains. His insights into gold and silver dynamics showcased gold as a reflection of currency degradation and silver as a potential outperformer. Oliver's cautionary note urged investors to stay resilient amid temporary downturns. Looking forward, he emphasized the Federal Reserve's role, predicting a continued need for money printing and advising investors to be nimble, especially as the 60-40 portfolio's safety wanes. The key takeaway, 2024 may usher in a new era, urging investors to consider alternative assets and stay vigilant in a dynamically shifting financial landscape. Now, we'll show you clips of Michael Oliver, but kindly remind to subscribe to the channel as everything helps with the algorithm, and watch the video to the end. Check our links in the description if you want the best sign up, bonuses in the industry to accumulate digital gold, also known as Bitcoin. Enjoy.
Which we've actually sort of emerged out above if you look at just price even. Where you make a high at 30, you make a high at 28, you make a high at 26, make a high at, et cetera. So it's been gradually decaying with some nice spike lows down there. Like we were $17 last year. Now silver's 23, 24 zone. Well, percent wise, that's a bigger move up off the low than gold is off of its October low last year. But still, people have been among it. We think silver's broken through every hurdle, technical hurdle we need to see to indicate it's restarting itself. Another major up leg. The last signal we're going to offer, and we get very specific with our subscribers, but basically it's if you get back over 25 again, put your helmet on. Now, if you look at a price chart, the last two highs, I think it was July and August, were just above 25. So getting back there again, somebody's going to say, well, let's sell it again. Better not. I think silver goes through that 25 level. It's going to take out 30 in a heartbeat. And I think silver is going to percent-wise vastly outperform gold over the next year. And a major point we're making too. The prior bull trends in gold lasted about 9-10 years or so. Like the early 70s, it was in the $30 zone, went to $8.50, okay, by 1980, okay. 2000, year 2000 was trading around $2.50. By 2011, it's 1920, okay, but a decade or so. Most of the percentage of the price gain of those bull markets came in the final year of the bull trend, meaning the 8th or 9th year or 10th year. We're now 8 years old, bottomed in late 2015 at 1,050. We've doubled since then in gold. Okay, so it hasn't had the ratio move of those moves, which were eightfold moves. We've only doubled. And yet we've got these macro fundamentals that could drive it a lot higher. But you've got to be careful because late in the trend, after laborious bull trend, that's when you get this engagement that is so dynamic that it takes your breath away. Like, for instance, I think it was back in 2010 or so to 2011, silver went from like $20 to 50. Did most of its move in about 3/4 of a year. Same was true in 1979. Silver exploded and got up to 50, or, it did most of it in 3/4 of a year in 79. We're getting late in this bull trend too, so it wouldn't shock me that either 2024 or 2025 is that year where you get verticality, especially given the fundamental and technical dynamics in these other asset categories that will drive the Fed to liquidity issues again, which will fuel the gold move and silver. Ratio basis. Silver to gold, if you look back historically over the last 50 years, you'll see it's gone up to 6.5% of the price of gold. It's been multiple times well over 3% of the price of gold. So it's not like it's rare for it to be there. Right now, it's above 1% of the price of gold, like 1.3. If gold were to match the ratio moves that it had in 1970 and 1980, or 2000 to 2011, it would go to $8,000 and merely match the ratio, eightfold. If silver were even 2% of the price of gold or 3% of the price of gold, and gold was at 8,000, you do the math. It's off the page, hundreds of dollars. We don't think it's a ridiculous assertion. And I think that a lot of that is going to occur late in this bull cycle, which began again from the 2015 lows. So I think silver is going to be an outperformer. Also, I think the miners, and they do this repeatedly, they underperform, they go with gold, but when gold pauses, they pull back. Gold goes sideways, they pull back. And they're very depressing. But then when they get reborn, go back and look at the spring and summer of 2020, for example. Did you want to own gold then or miners? Miners beat the pants off of gold on a ratio basis. Yeah, it was only 6 months or so, but it was huge. I think they're positioning again for another such move. And we measure the spread relationship between the miners and gold and silver and gold. So we don't just look at their price charts and say, well, this was, et cetera. We measure them via spread analysis and momentum of the spread. And right now, it wouldn't take a lot for silver to re-engage into a positive mode versus gold on a relative basis, and for the miners to do the same. And I think GDX is on the edge of that. Remember, GDX, I think 17% of it's Newmont and Barrick. And if you look at what happened to them over the last couple of weeks, percent-wise, quite an upturn, which indicates to me that some large asset managers are moving into the blue chips of the miners for some reason. We know the reason.
Thanks for watching the video till the end. Post in the comment section your opinion on today's show, as it's very important to us to know your honest opinion on the matter. And I see you on the next one.